Hey everyone, welcome to this channel at X World. This is another video in the IGCSE Accounting series. Until now, whatever topics have been covered in this series, those were all related to basic principles of double entry, recording of transactions, preparing the statements, understanding each element of the financial statements, and so on. But in this video, we are going to study how to analyze and interpret the financial statements. Once the financial statements are ready, how do the users of the financial statements interpret them, and what useful information can be brought out from these financial statements so that necessary decisions can be taken. So we first understand the important terms that will help us understand the different kind of ratios later. Then we see the three category of ratios: profitability ratios, liquidity ratios, and activity ratios. Under each of them, we have some specific ratios to be covered. We would understand how to calculate these ratios. Now, important than calculation. Now, calculation is still fine. You could just remember the formulas and calculate, but it is very important to analyze the ratio. Once it is calculated, looking at the ratio, do you think it is good? Is it bad for the business? And so on. Such analysis is very important. You should learn how to do analysis for each and every ratio. And at the end, we will see what are the advantages and disadvantages of interpreting the financial statements using ratio analysis. Let's cover the important terms first. Working capital. Now, working capital refers to the net current assets invested in the business. Net current assets is equal to your current assets minus your current liabilities. What is the importance of working capital? Working capital shows you how much funds are available in the business to run the day-to-day business operations. Working capital can be calculated as current assets minus your current liabilities. Current assets you would be knowing would be like inventory, trade receivables, cash and bank balances. Current liabilities would be trade payables, other payables, etc. Our next important term is capital, which you would already be knowing. Capital refers to the amount invested by the owner in the business. For sole traders, it is the amount invested by a single owner. For partnership firm, capital would be the capital invested by all the partners in the firm. And for a company, a limited company, capital would refer to total equity in the firm, which is made up of your share capital, reserves, and retained earnings. And finally, we have capital employed. Keep in mind, capital employed is not the same as capital. Capital employed refers to the total funds invested in the business. Now, investments in business could be either by the owner in form of capital, or it could be by the lenders in form of long-term liabilities like loans. Whereas capital, we've already seen, is only the investment by the owner. So that's the difference between capital employed and capital. The formula for capital employed would be owner's funds, which is the capital, plus any borrowed funds in form of loans, debentures. This would give you the total capital employed in the business. Let's say if the owner's capital and the loan funds are not given in the question, they're not available to you. Is there any other way to calculate capital employed? Yes, there is another way to calculate the capital employed. Now, capital employed could also be calculated as your total of your non-current assets plus your working capital. Working capital we've already seen is nothing but current assets minus current liabilities. In other words, capital employed would be equal to non-current assets plus your current assets minus your current liabilities. Starting with our first set of ratios, profitability ratios. Now, these set of ratios help you determine how profitable the business is when compared to any other firm, or when compared to any previous period of the same business, how profitable the current period is. Under the profitability ratios, our first ratio is the gross profit margin. Gross profit margin expresses the gross profit as a percentage of your net sales. It shows for every $100 of sales, how much gross profit the business has been able to generate. Looking at the formula, a formula would be gross profit upon net sales into 100. Net sales is after deducting your sales returns or return inwards. The gross profit margin helps us to analyze the gross profit earning capacity of the business. A higher gross profit margin indicates that higher gross profit is available for the business to pay its other expenses in the firm and eventually earn a higher net profit. Can we improve the gross profit margin for a business? Yes, you could take certain steps in improving the gross profit margin. It is very logical to understand the steps involved in improving the gross profit margin. See, gross profit margin is made up of gross profit. Gross profit is made up of sales less cost of sales. So if somehow I can improve my selling price or reduce my cost price, I'll be able to earn a higher gross profit for every $100 sale. So my first step to improve gross profit margin would be increasing the selling price or reduce the trade discount that you offer to the customers. Second way would be to reduce the purchase cost or the manufacturing cost so that the cost of sales can be reduced. Change the sales mix, meaning if a business is dealing in multiple products, it can start focusing on products that yield higher gross profit and focus less on products that yield lower gross profit. Now, many students have seen they are always confused with this point. They feel that increasing the sales volume will increase the gross profit margin, but think about it. Is it true? Let me give you a small example. Let's say there's a business that sells just 1 unit of a product during the period where the selling price is $10, cost price is, let's say, $6. So gross profit would be $4 per unit. And if you calculate the gross profit margin, 4 divided by 10 into 100, 40%. The same business, if it sells 100 units of the same product at the same selling price and cost price, gross profit margin will be gross profit earned, which is 400 divided by net sales, which will be 1000 into 100, 40%. So I hope you realize that increasing the sales volume has no impact on the gross profit margin, because margin is nothing but the gross profit per unit divided by the selling price per unit into 100. So there are 3 ways in which you can improve your gross profit margin. Our next ratio under this category is the net profit margin. Now, net profit margin expresses the net profit as a percentage of your net sales. It shows you for every $100 sale, how much net profit can the business earn, or how much net profit is the business earning. Looking at the formula is very simple. Net profit upon net sales into 100 expressed as a percentage. Given the net profit of a business, what could you analyze? You can analyze that a business with higher net profit margin is either earning high gross profits or it is able to control its other expenses better, or both of them, both the reasons. Can we improve the net profit margin for a business? Yes, you could improve the net profit margin for a business. Now, what is net profit? Net profit is gross profit minus your other expenses. So if somehow we can increase the gross profit of the business or reduce the other expenses of the business, our net profit margin will definitely improve. So first step in improvement is steps that you have to take to increase the gross profit. Now, this could be by increasing the gross profit margin or by increasing the volume of sales, etc. Next would be to have better control over business expenses so that your eventual net profit is high. Our last ratio under the profit ratios is the return on capital employed. Capital employed is the total funds invested in the business. So our ROCE expresses the operating profit as a percentage of capital employed. It shows how much operating profit the business is earning for every $100 capital employed. From the previous chapter on limited companies, I've already told you the difference between operating profit, non-operating profit, or operating expenses and non-operating expenses. If you've not seen that video, I would suggest please go and check the video out. I'll put the link in the description below. Now, the formula for return on capital employed would be operating profit upon capital employed multiplied by 100. Now, this ratio is expressed as a percentage. What does a higher ROCE indicate? It indicates that the funds that have been invested in the business are utilized efficiently, utilized in a better manner to increase the profits of the business. So as an investor, when you're choosing to invest in multiple firms, you would obviously choose companies, or you will obviously choose businesses that have a higher ROCE, because for every $100 that you invest in a company with high ROCE, you'll obviously earn higher returns. Can we improve ROCE of a business? Yes, you could take steps by increasing the overall profit. That includes take steps to improve the gross profit, take steps to improve the operating profit by reducing the operating expenses. And this way you could ensure that the capital invested in the business is utilized efficiently to maximize operating profit for the investors. One thing that you have to keep in mind is that the numerator is operating profit and not net profit. What do you mean by operating profit? I'll write on the formula here. Operating profit refers to your gross profit minus your operating expenses. Now, operating expenses are all business expenses that you have to pay on your day-to-day basis, except your interest on loans or interest on debentures. So do not deduct the interest and you would be able to arrive at the operating profit. Our second category of the ratios is liquidity ratios. Now understand the term liquidity. Liquidity means the ability of the business to meet its short-term liabilities. In the short term, whether the business will be able to meet or pay its current liabilities. Our first ratio is the current ratio. Current ratio compares the current assets of the business to the current liabilities of the business. It shows how much current assets the business holds for every $1 current liability. Higher the ratio, better is the ability of the business to meet its current liabilities. Formula would be current assets upon current liabilities. Now note the expression of the ratio. Let's say current assets upon current liabilities is 3. So the expression of the ratio would be 3:1. If the ratio of current assets to current liability is 2, the expression of the ratio would be 2:1. It is generally said that the ideal current ratio suggested is 2:1. It means current assets should be generally twice to that of current liabilities. What happens if the current ratio is lower than 2:1? It indicates a risk of non-ability of the business to meet its current liabilities in the short term. And what if the ratio is higher than 2:1? It obviously the business would be able to meet its liabilities, but then it also indicates inefficiency in the management of current assets. Maybe the business is holding a lot of inventory, or the business is holding a lot of trade receivables, not able to collect the debts from its customers on time, or a lot of cash or bank balances are left idle. All these indicate inefficiency in management of working capital or current assets. What steps can be taken to improve the current ratio? Let's say we have a lower ratio than the ideal ratio or the industry standards. We can increase the numerator or the current assets to improve or increase the current ratio. This can be done by, let's say, owner investing more funds in the business. That way we will have more current assets in form of cash or bank in the business. We could take long-term loans for now so that we at least increase our cash balances now. Unused non-current assets can be disposed of. The owner can withdraw lower amounts for personal use. All these will make sure that higher working capital is available in the business to pay off the current liabilities. In case of a very high ratio, the current assets will have to be efficiently managed. For example, if inventory is very high, steps will have to be taken to reduce the level of inventory, bring down the old inventories, dead inventory levels. If the trade receivables are very high, the business must take steps to ensure collection from debtors on time, so that there are lesser chances of bad debts. If the cash and bank balances are too high, and as a result the current ratio is very high, then steps could be taken to invest excess cash or bank balances in profitable investments. So we can use these ways to ensure better management of business current assets. Our next ratio in the liquidity ratio is the quick ratio or the liquid ratio, also known as asset test ratio. See, in our current ratio, our formula was current assets upon current liabilities. Now, current assets includes inventory. And the purpose of calculating current assets was to determine whether in the short run, within 1 year, business will be able to use all its current assets to pay off its current liabilities. But the inventory that is included in the current assets, can we say for sure that we'll be able to sell off all the inventory that is there within 1 year and pay off the current liabilities? In most cases, no. A business may not be able to dispose of or sell profitably all its inventories and pay off the current liabilities. So a more prudent approach or a prudent way is to calculate the liquid ratio or the quick ratio that excludes the inventory from the numerator and then calculates the ratio. So our formula would be current assets minus inventory upon current liabilities. Now this ratio measures whether the business will be able to meet its current liabilities using its current assets excluding inventory in the very short term, in the next few months. An ideal quick ratio is suggested to be 1:1. So if a business is having its liquid ratio near the ideal ratio, it can be said that the business is in a comfortable position and will be able to meet its liabilities. A very low ratio indicates risk of non-payment, and a very high ratio indicates inefficiency in business management or in working capital management. Can we improve our liquid ratio? Yes. All these steps that were discussed earlier in improving the current ratio, all of them would be applicable here also, except the inventory part, because inventory is not included in the liquid ratio at all. Our next set of ratios are activity ratios. These ratios help you determine whether the business operations are being managed efficiently or no. First ratio under activity ratio is the rate of inventory turnover. Now, rate of inventory turnover measures the rate at which a business is turning or selling its inventory during the period. How many times the business is buying and selling its inventory during a period to maximize its revenues. The formula for rate of inventory turnover would be cost of sales upon average inventory. Cost of sales was obviously opening stock plus purchases minus closing stock, adjusted for any purchase returns obviously. And average inventory is opening inventory plus your closing stock divided by 2. Now this ratio is measured in times, how many times the business is turning its inventory. Now there is no ideal inventory turnover ratio because this ratio would differ from industry to industry. Some industries would have a very low inventory turnover ratio, while some industries could have a very high rate of inventory turnover. So the firm's rate of inventory turnover will have to be compared to the industry standards to determine whether the firm is selling its goods faster than the industry or at a slower pace. If the firm is selling its goods faster than the industry standard, then it is beneficial for the firm because there are lesser chances of your dead stock and low storage cost will have to be borne by the firm. Whereas in case of a low rate of inventory turnover, storage costs are high, plus there are higher chances of dead stock or loss of inventory in form of old items, old unsold items. Can we improve the rate of inventory turnover? Yes, we can improve the rate of inventory turnover by taking certain steps. We can invest more in fast moving inventory items than keeping in stock the slow moving items. Another way is to offer trade discounts to customers. This is useful when the business has already built up a lot of old stock, dead stock, and it wants to clear off the inventory. So a one-time trade discounts can be offered to customers so that the old models or old stock can be sold off. Our next ratio is the trade receivables turnover ratio. This ratio measures the time taken by customers to pay off the debts to the business. The formula would be average trade receivables. Again, average is calculated as opening trade receivables plus closing receivables divided by 2. And net credit sales is net of sales returns. Only credit sales, net of sales returns. Multiplied by 365, and this ratio is calculated in terms of days. How many days the customer is taking to pay off the business debts. If I multiply this ratio by 52 instead of 365, I would get this ratio in weeks. If I want the ratio in months, I could multiply by 12 and then I would get the ratio in months, and so on. This ratio, once we calculate, can be compared to the credit period that was agreed with the customers and see if the business is able to collect its debts within the time agreed. If the business is taking more time than it was agreed, then it shows inefficiency in debt collection by the firm, and steps may have to be taken to improve the debt collection, else there would be higher chances of bad debts in the future. Following steps can be taken. We can offer cash discounts to customers. When cash discounts are offered to customers, they tend to pay before time. We can charge interest on overdue accounts. When interest is charged, customers, if possible, they will pay on or before time to avoid any interest being charged. From business point of view, invoices and statement of accounts should be sent on time. Customers should be reminded on time so that they can pay their debts on time. Another drastic step that can be taken is to refuse to supply to customers who are not paying their old dues, and unless they don't pay their dues, goods should not be sold to them. If the business is really selling good quality products at good prices, customers may want to avoid such a situation and they will make sure that they clear their dues on or before time. Our final ratio is the trade payables turnover ratio. This ratio measures the time taken by business to pay off its credit suppliers for the goods purchased on credit. Our formula would be average trade payables upon net credit purchases multiplied by 365, and hence I get the ratio in days. If I want the ratio in weeks or months, I would instead multiply by 52 or 12 months respectively. The trade payables turnover ratio can be compared to the credit period that was agreed with our suppliers to compare if we are paying on time, before time, or we are taking more time than it was agreed. If we are paying before time, it indicates that we are not making a full use of the working capital that is available to the business. Whereas if you're taking more time than it was agreed with the suppliers, it could be disadvantageous for the business because the supplier may start charging interest, may refuse to supply to us. We are losing any opportunity of availing cash discounts. Supplier may start charging higher prices, etc. In this video, we've seen some ways of doing ratio analysis by calculating some relevant ratios. Now, there are certain advantages and disadvantages of financial statement analysis. What are the advantages? Standalone financial statements are not very relevant. You cannot compare standalone financial statements because the comparison would be really meaningless, especially if the comparison is between firms of different industries, firms of different sizes, a small firm and a big firm, etc. Once I have the ratio analysis, it becomes very easy to do inter-firm comparison and intra-firm comparison. Inter-firm comparison means comparison between two firms, while intra-firm means comparison of the same firm but for two different periods. Trend analysis is possible. We can analyze or predict future trends and take steps in the right direction. For example, if there is a consistent trend of gross profit margin falling, we can take necessary steps to improve our gross profit margin for the coming periods. There are certain disadvantages of financial statement analysis. The analysis cannot be very useful if the firms for which the analysis is being done and the ratios are being compared, they're following different accounting policies. For example, policies related to inventory valuation, policies related to depreciation. If they're using different methods, different rates, the comparison may not be very meaningful because these policies directly impact your financial statement figures like profits, total assets, etc. The non-monetary aspects of businesses are ignored here. For example, a firm with good senior management, this fact will not be reflected in the ratio analysis, and that part of the firm is ignored when doing financial statement analysis. Firms could have different year-ending dates that could also impact the ratio analysis. For example, seasonal businesses could maintain different inventory levels during different parts of the year. So a business that has having year-ending date near the on-season, when compared to a different business having year-ending date near the off-season, the inventory levels could obviously be different. And looking at the numbers, it cannot be said that a certain firm is better because of high or low inventory levels. I hope you've enjoyed watching this topic. I've tried my best to simplify this topic, give you all the relevant points, relevant formulas that are necessary for the exam, and at the same time make you understand the concept or the analysis behind each ratio. If you really enjoyed the video, please like the video, please share it with your friends, and you can put down the comments below. If you have any doubts, if you want any clarification, feel free to comment below. I'll see you in the next video. Thank you.